while you're the global reserve currency, generally becomes untenable to all the other countries that hold your sovereign debt. And so as that shift occurs, you often get shifts in the global monetary system around it.
As you're mentioning, the GDP to um, money supply ratio. Um, can you dive into that a little bit more and why this particular ratio is quite important in looking at the long term debt cycle?
Yeah, so there are a couple ways to measure debt. One of them is debt to GDP. So that's the amount of debt in the system compared to economic activity. And that's generally one of the more important ones. But another one to look at is debt relative to money supply. And the reason that's important is because policymakers have more control over money supply than they have over GDP, and so that's kind of a measure of the shifting fiscal monetary policy that you see playing out. And so if you look back over time, debt as a percentage of money supply tends to peak right when you hit the zero bound in terms of interest rates. So that happened back in the 1930s, and that happened during the peak of the global financial crisis. And then when you go into that later stage, that's when you get generally a private sector deleveraging, where the public sector, however, continues to lever up. And so that's when you get that more inflationary outcome. Whereas that the private sector deleveraging tends to be more deflationary and tends to, you kind of unwind a banking crisis and recapitalize your banking system. And so it may seem inflationary at first, but it's mostly, I like to call it anti-deflationary. So these policymakers are basically offsetting a big bank collapse by printing a lot of money. But instead of that money getting out broadly into the system and resulting in too much money chasing too few goods, a lot of that money just stays internal to the banking system and recapitalizes it. And then it's not until that second punch later, like we saw in the 1940s and what we seem to be seeing here in the 2020s, we start to get the broad money supply going up rapidly because the banking system's already, well capitalized, but the real economy is still stagnant. And that's when you start to see kind of the massive fiscal deficits, the massive monetization of those deficits, and you start to eventually see a devaluation of the currency in exchange for kind of unwinding a lot of that leverage in the system.
So are we at a point where the response is perhaps the danger to look out for more than the actual deleveraging because they're going to respond to the deleveraging by printing. So we don't really have to worry about the deleveraging as much. We have to worry more about the unknown consequences, or not the unknown, but the unforeseen consequences of the printing. Is that accurate, or are there perhaps other worries to look at?
So that it depends kind of what position you're in, because many
Hmm.
people do have to worry about the deleveraging because they're heavily involved in it. So for those that are leveraged or invested in leveraged entities, it's not the case that every entity gets saved or bailed out. And
Hmm.
so for I like to, one thing I like to focus on is what happened in March. And so one of the consequences of there being so much treasury issuance and having so much of that owned by the foreign sector, is that when we had this big solvency event, so I mean a liquidity event in early March and April, when the pandemic hit, we had a reduction in global trade, we had energy prices collapse, we had offshore dollar-denominated debt became a problem, and so we started to see basically forced selling in treasuries. So the foreign sector began selling treasuries. U.S. hedge funds started selling treasuries to unwind risk parity, leveraged, investments, and that created basically an acute liquidity crisis because the treasury market is supposed to be the most liquid market in the world. It's supposed to be, a safe liquid investment. But during the heart of that kind of March crash, where everything was going down together, even long duration bonds started going down, and the treasury market became illiquid. So wide bid ask spreads, and the Federal Reserve stated that it basically ceased to function effectively. And so that's when we saw the Federal Reserve was forced to come in with aggressive policy response, and they bought $1 trillion worth of treasuries in 3 weeks. And they basically re-liquefied the market because there were just so many sellers relative to buyers. And so the Fed had to go in and kind of take the other side of that trade. And so, once it gets up to the sovereign level, it's one of those things where if there were to be a deleveraging, it literally goes all the way up to the treasury market itself, because even entities can't even hold treasuries because they have to sell their collateral in order to remain solvent. And so that's where basically you get that forced currency devaluation in response to that deleveraging event.
In your view, are we still kind of in the thick of the danger zone of we had the flare up in the repo market a little over a year ago, last September, and then in March. And so, were these still precursors to a more main event, or are we going to just keep chopping along, having these blips? The Fed comes in, tries to save the day, but it's just kicking the can. Are we just going to kind of live in this stuttering phase for a while, and until the currency is devalued and the deleveraging has just slowly happened, or is it going to play out in an actual event?
I think the repo spike in late 2019 was the precursor event. So that's the one that it didn't have a lot of consequences for most people, but for folks that were paying attention in the financial system, it raised a ton of red flags and forced a response by the Federal Reserve. Because if that response was not there, then the consequences would have been felt by everyone. And then it was, in March, I think was potentially the main event. So that's when we had the pandemic induced liquidity crisis. We had oil go negative the next month. We had all sorts of crazy dislocations in the market, and that's when we saw the biggest ever, the most rapid liquidation by the Federal Reserve to basically reliquefy markets. Now there is always a risk that there's still like one more big one around the corner, and I think that there's risk here in late 2020, early 2021, because we're still going through the pandemic. We still have this winter ahead of us, but I think my base case is that March really was the main event, and that now I think you put it a good way. There's going to be kind of fits and starts. There's going to be sputters along the way. So every time something breaks, the response time is likely going to be pretty quick, because they're already in that kind of that mindset of supplying liquidity and kind of realizing that the system's so vulnerable. And so I think it's kind of like you can get these kind of like repo spike events where something kind of breaks under the surface, but it doesn't spill out to the degree that it did in March.
With all this printing, what's the danger of that? I mean, we know how it's good. It can inject liquidity and solve certain things, but what are the dangers with solving the problems by devaluing the currency? Like what do we need to look out for?
Yeah, so currency devaluation is one of those things where I've thought of it as kind of like chemotherapy for a cancer patient. So it's often one of the best solutions in a bad situation. So all the things that led up to that were basically things that happened before. So by the time it's time to do chemotherapy, it's because the patient already has cancer.